Amazon, Google, Meta, Microsoft, and Oracle are projected to spend around $700 billion on AI infrastructure this year. The global AI market is generating roughly $65 billion in revenue right now, and a significant chunk of that $65 billion in AI revenue is not coming from real customers. The industry is, in large part, paying itself. For example, Nvidia finances AI startups. Those startups turn around and buy Nvidia chips, and Nvidia books it as revenue. Microsoft invests in OpenAI. OpenAI spends that money on Microsoft Azure, and Microsoft reports it as cloud growth. Researchers who studied this circular pattern found that $1 of loss-making customer revenue can ripple into more than $8 of reported AI revenue across the supply chain. And the debt funding all of this has its own collapse mechanics, regardless of whether AI eventually delivers. Big Tech issued over $100 billion in bonds in 2025 and another $100 billion in early 2026. Morgan Stanley projects $1.5 trillion in cumulative AI debt issuance over the next 5 years. Amazon's free cash flow is projected to go negative this year by up to $28 billion. This is what it looks like when an industry stops proving itself and starts financing itself instead. So when it breaks, who breaks first? The most immediate casualties are a category of companies called neoclouds, businesses like CoreWeave, Lambda, and Nebius. Think of them as specialized GPU landlords. They borrow billions using the GPUs as collateral to build massive data centers, then rent that computing power out exclusively to AI companies that need it to train and run their models. Unlike Amazon or Google, which serve thousands of different business needs, neoclouds have one customer type, but the problem is that the GPUs they borrowed against lose value much faster than anyone admits. On paper, these companies claim their chips will stay useful for 6 years, but short seller Michael Burry, who called the 2008 financial crisis, argues the real useful life is closer to 2 to 3 years. Even Amazon, one of the biggest GPU buyers on the planet, was forced to officially shorten how long it expects its own chips to remain useful, because AI hardware is advancing so fast that last year's chips become outdated before the loan is even paid off. You are essentially borrowing against an asset that is shrinking in value while you pay interest on it. CoreWeave alone carries over $20 billion in debt and spends nearly a third of its quarterly revenue just on interest payments, and it gets 67% of its revenue just from Microsoft. This is what happened to WorldCom and Global Crossing after the dot-com crash. They borrowed billions to build fiber optic cable networks across the world. The demand did not arrive fast enough, and they collapsed anyway. The neoclouds are the WorldComs of this cycle. What makes this crash more dangerous than the dot-com collapse is that the debt layer is far more complex. Some of these data centers are sitting inside off-balance sheet financial vehicles called special purpose entities, similar to the structures that hid Enron's liabilities before it collapsed. Last December, Oracle's credit default swaps hit their highest level since the 2008 financial crisis after a failed $10 billion bond raise, and the financial structures underneath all of this have been growing at a terrifying rate. Data center asset-backed securities have grown from $2.6 billion in 2020 to over $14 billion today, and are projected to hit $50 billion by 2027. That is the same mechanism that spread mortgage risk across the global financial system before 2008. When the underlying asset loses value, everyone holding those securities loses at the same time. This is not just a story about tech companies and venture capitalists. The Magnificent Seven now make up roughly 33% of the entire S&P 500. That is higher than the concentration the market had at the peak of the dot-com bubble in 2000. What that means in practice is that every index fund, every retirement account, every pension tracking the S&P 500 is a concentrated bet on AI continuing to deliver. Household equity ownership is at 30% of total wealth right now. In other words, 30 cents of every dollar of wealth that ordinary American families own is now sitting in the stock market. That is a record high, and a huge chunk of that is sitting in index funds dominated by a handful of AI-exposed tech giants. Most people have no idea their retirement savings are this exposed to what happens next in Silicon Valley. And then there is Nvidia. It is the single most visible symbol of the AI boom. Its market cap just crossed $5 trillion, making it the most valuable company on Earth. Cisco Systems was like Nvidia before the dot-com crash. It was the most valuable company on the planet then. Investors believed it would power the internet forever. It was selling networking hardware that the internet genuinely needed, but the valuation had detached from reality. 18 months later, the stock had lost 88% of its value, and 25 years after that, it has still never recovered. Nvidia today is not Cisco in every way. Its margins are higher and its dominance is more complete, but the pattern of a single infrastructure company being priced for permanent monopoly at the peak of a technology cycle is identical. The DeepSeek shock in January 2025 wiped $589 billion from Nvidia's market cap in a single trading day. That was one piece of news about a cheaper AI model from China. Imagine what a neocloud bankruptcy or an OpenAI down round does to the same stock. The people who will feel this are not just hedge funds and venture capitalists, they are anyone who has a retirement account sitting in an S&P 500 index fund and has not thought twice about it. That is most working adults in the United States. This bubble, when it deflates, will be felt far beyond Silicon Valley. When the bubble bursts, one of the most immediate and widespread consequences will be unemployment. And not just in Silicon Valley, we are talking about a global labour shock that hits engineers, construction workers, electricians, and entire regional economies that have quietly become dependent on AI spending, and the layoff wave is already happening right now before the bubble has even popped. In the first quarter of 2026 alone, nearly 80,000 tech workers were laid off. Almost half of those positions were directly attributed to AI automation. Oracle cut up to 30,000 workers in a single round to fund its AI commitments. Amazon shed another 30,000, Block cut 40% of its entire workforce. These are the pre-crash cuts. The efficiency phase, companies replacing humans with AI tools to fund their AI bets. If the bubble actually pops, you get the second wave, and it is much larger. When hyperscaler capex falls, everything connected to it falls with it. Right now, there are towns across Virginia, Texas, and Iowa whose entire local economies revolve around data centers. When that spending stops, those towns do not have a backup plan. After the dot-com crash, tech employment dropped by 45% and did not fully recover for 11 years. Apply a comparable contraction to today's AI-exposed labour pool, and you are looking at somewhere between 300,000 and 500,000 direct job losses, with multiples more rippling through the surrounding economy. But the dot-com crash also showed us that after the pain comes the reset. The inflated salaries disappear, the fake jobs disappear, the companies that were built on pitch decks and hype disappear, and what is left is something more honest. The engineers who are actually building real things get room to breathe. The companies with real customers and real revenue stop getting drowned out by the noise. Every major technology we rely on today, like search engines, e-commerce, social media, and cloud computing, was built in the years immediately after the dot-com crash. The bubble does not kill the technology, it kills the fantasy around it, and sometimes that is exactly what needs to happen. Public trust in AI is already collapsing before anything has officially broken. A 2025 Pew Research study found that 50% of Americans are more concerned than excited about AI in daily life. Only 17% believe its long-term impact will be positive. Brands are already responding to it. Heineken, Polaroid, and Apple are all running Made by Humans campaigns because their own research tells them authenticity has become a competitive advantage. The organic food label of the 2020s is going to be a human-made stamp on creative work, and a widely cited MIT study found that 95% of enterprise generative AI pilots show no measurable profit and loss impact. When the bubble finally pops, it will validate everything the skeptics have been saying. The critics who were called Luddites in 2023 will be reframed as people who were simply paying attention, and the founders who were on magazine covers, the ones who promised to change everything, will quietly disappear.